Welcome to the recorded workshop session for the Business Management Distance module.
In our last and the final segment, just to close off all the learning units, the chapters that we are going to be examined this semester in Business Management 1B. Thank you very much. It's only a pity that I haven't been in contact with you. I'm not seeing you responding to some of the issues that we also communicate, and it's also, let me also let you know that the doors are always open, that if you're also having any queries, you can still help come out and also assist you. Now, today we want us to look at something that is so important, and I'm sure from your accounting, you have been learning about finances or accounting. That is the recording of all financial transactions in the books of accounts. But today we just want us to dwell in that aspect, in that area, but in the area under the helm of financial management. Now, financial management, you will discover that it is a topic, and it is a topical topic that is very important even in any organization, even in our lives, even as individuals. Now, one thing that is very important that anybody might want to know is what is the relevance and what is the importance of financial management. Now, financial management, even as a subject, you will discover that it is concerned with the flows of funds. So, now, it actually is concerned as to the flows of funds in the organization. You know that the goal of an organization is to make profit. Now, what happens is money we transact every day, even in any business. Just imagine the transaction that you are involved in, even at our college, at Rosebank College. You find a place, you go pay. So to Rosebank College, it means it's money coming in. But what happens is, as lecturers, we are also paid. So my salary would act as a flow, but it is outward flow. So financial management is a subject that deals with and is concerned with how money is coming in and how money is going out. And I'm sure in your accounting, you have also done cash flow management. Now, cash flow management is also another arm of financial management. Now, we say that financial management is concerned with the flows of funds. It is not only concerned with the flows of funds, it also is concerned with the acquisition of funds. With the acquisition of funds. Now, to acquire, that is to get. So another word for acquisition would be to what? To get. So we can talk of acquisition as to get. So the question is, somebody would say, how can a company be concerned with how can it get some money for itself? The thing is, it always gets something, say, from shareholders, from investors, and from individuals buying shares within the company. That's how a company can also acquire funds. Now, an organization, once again, can also look for application of funds or the acquisition of assets, that is equipment, in which it can actually use to generate more money. So we can also talk of acquisition of assets. We can also talk of the actually the concerns of financial management as the administration again. Administration, reporting on So it is quite important, even as managers, to understand that arm of financial management. So these 4 pillars would actually talk about what financial management is all about. So in summary, we would say it is concerned with the flow of funds. The other word for funds is money. We can also talk of money. So we can say flow of funds, which is also money. Right? And then acquisition, that is to get what? Funds, to get money. The acquisition of assets, the assets that are used to generate what? More money, generate more income within the organization. And it is also responsible for the administration. And when you are administering, you are also ensuring that the money is safe and all the paperwork that is necessary is also done. And also reporting, that is also reporting and coming up with documentation that you give to the shareholders to know what is actually happening. And also on financial matters, anything that is happening within the organization. So financial management only focuses on money. Now, there is a relationship that exists between financial management and other areas, functional areas within the organization. Financial management is not a standalone aspect within an organization, but what it does is it interrelates. There's an integration. There is a relationship that exists between finance department Right. One thing that is also very important as we continue to talk about the relationship that exists between financial management and other functional management areas is that there is the environmental factors. The environmental factors also include the type of business or the form of business that you are running. Financial institution in that area, in that country in which you are actually operating. Remember, it is the Reserve Bank that comes with rules and regulations regarding how the business should be run. There are also incentive measures that are also given. There is also legislation. Remember, the government is the one that sets rules and regulations regarding how financial institutions should operate, and also the laws of taxation. There is no way even as a company you can continue to run without also being taxed. So that is also very important. And even when you are in your financial dealings, that we also consider also such things. Another area that is also very important is other subjects of and disciplines that are involved in financial management, other than the management aspect. And also we also talk, when we talk of financial management, we also talk of things like accounting, right? As you are doing your accounts, you are taking into account recording the financial transactions. But when you do that at one level, you find yourself also doing cost accounting. Here you're actually taking into account to say, if we are going to produce this, how are we going to manufacture and how much are we going to make out of producing this? What is the cost of producing one t-shirt? So in this discipline, you're actually factoring in components of how much is electricity going to cost us if we manufacture one t-shirt. How about 100 t-shirts? How many people would be involved in that kind of a project? The receptionist, how much will you be paying a receptionist? That is cost accounting. How much will you pay the people who are going to deliver the t-shirts? How much will we charge the final t-shirt? So the real thing that is actually happening is you are taking into account every financial implication that comes across. We also take into consideration economics. We take into consideration statistics. And we also take into consideration communication science. There is no way we can continue operating without communicating. Now, the concepts in financial management are quite a number, but we are all quite familiar with the balance sheet. And this is an instant photo of the financial position of an organization. So from your accounting, I'm sure we have heard the definition that a balance sheet or a statement of position, I think, is that document that actually takes a list of assets and liabilities that the company is owing. Now, the asset size, they reflect on the possessions of the company. Number two, they might be fixed assets or current assets. Fixed meaning that they are not easily converted into cash, but current assets are easily converted into cash. You might also have them in the form of liabilities. And liabilities, it reflects what the company and the nature and extent of interest in assets that the interest is incurring. This could be long-term funds that you have borrowed from somewhere. Remember, in the definition, when we started off, we said financial management looks at the way in which the acquisition of funds. So when you talk of acquisition of funds, recording the funds that have been acquired from somewhere, they might be in the form of long-term funds, shareholders' interest, short-term funds. If there are short-term funds, it means you have borrowed a company, you have borrowed individuals for a season, and you are going to return it within a stipulated time. Now, capital is also another word that we are going to be familiar and should be using even in finance. This is the accrued power of disposal of products and services used by a business to generate monetary profit. So in simple terms, we can say capital is the money that we use to start a business to generate more money. It is like an investment, and capital for investing, we can use the capital to invest in fixed assets. And also, we also can actually have capital for investing in current assets. That is the need for working capital. Every business needs money that it used to reinvest, to buy, it's used to order its materials and the like. So that's it with capital. But we also have something that is also interesting, which is income. Now, there is no way we can talk of financial management without talking of the subject of income. Now, with income, what is happening? This is the receipts resulting from the sale of what? Products. Receipts as a result of the sale of products. Let us assume that when you accept a place at Rosebank College, what do? You show that by registering. And during registering, you pay your money. And when you pay your money, what is it? That is registration. According to you, it's an expense. But in the eyes of Rosebank, this is an income. Why? Because they're going to give you a receipt and a list of those receipts. If it is 20 of you who have paid, we'll call them as income. But from that income, it doesn't mean that profit is already made. There are also expenses that the institution would pay. Now, income can also be the unit sold times price per unit. Let me write this. So what are we saying? We are saying for us to have a total income, to record an income, you need to calculate the units that have been sold. The units that have been sold times the price per unit. Let us say that we are selling maybe cars, right? And in our storeroom, we have got 20 cars. And we are selling the cars for 100,000. So what is happening is that on a particular day, what happens is that we sell 5 cars. So we would say unit sold is 5 cars times, we say the price of a car is going to be 100,000. So we say times 100,000. And then what do we have as our income for the day? For income for the day would be 5 times 100. That is, the unit sold is 5. Price per unit is 100. So here we are, unit sold is here, and this is price per unit. So price per unit is 100. Unit sold is 5. Hence we say 5 times 100,000. So 5 times 100,000 becomes 500,000. So we record the 500,000 as income. So we'll take this 500,000 as income. Why? Because this is the money made. This is what we have made, or this is what we have sold on a particular day. Okay, so we have made this, we have also sold this. So that is how we would record income. Now, costs is something else, and we can talk of costs as expenses. We can say these are costs, or we record them somehow even as expenses in our income statement, right? So costs, this is a monetary value sacrificed in the production of goods or services. And in any business, like the example that we gave, that say you are manufacturing cars, we have various types of costs. This can be called direct cost. And I'm sure if you've done manufacturing accounts, in your accounting, you have actually understood, you have actually learned more about this. So we have direct costs. These are costs that directly impact the business, say in the ordering of, that they incur, say in the ordering of raw materials. Indirect costs, this can be some of the costs that you experience in manufacturing. Overhead costs, this could be like electricity, that you also incur in the business. You might also have fixed costs that are there, like rent. This could be an example of fixed cost. We might also have variable cost like electricity or telephone bills. These are variable, they change from one month to another. You might also have what you call semi-variable cost and variable units variable cost per unit, and also you would have total cost. So when you talk of cost, it comes in different phases. It comes in different ways, but at the end of the day, this is money, a monetary value that is sacrificed in the production of goods or services. So let me define it and write it on the board. So what is happening is that this is a graphical representation of cost. So we are saying that even as costs start to increase, as cost increase, the quantity might also increase. But with this graph, it is showing that this is total fixed costs. These are total fixed costs, right? But you discover that sometimes even when the costs are increasing, the quantity produced also, the quantity might also increase, because as long as all things are equal and some things are kept what? Fixed, and you are not, there's no wastage. But this is a graphical presentation of total costs. Now, we also have a graphical presentation of, okay, maybe we can, let me go back here. So what are we saying here with fixed costs? Now, in a company, when you're manufacturing goods, as the cost of production goes high from zero here, from zero, and maybe going up to 10, what happens? Quantity that is produced, and when maybe when the quantity of that is being produced can also be increasing. But what happens here is that the costs of the fixed costs per unit begin also to what? Begin also to reduce, say, in value and become maybe like flat somewhere where there is an element of constance, right? Now, profit again, you discover that it has got its own definition. So fixed cost, maybe just before I talk of profits, you discover that with fixed cost, when the cost of production also goes high, they also reach a certain stage whereby they are constant. But fixed costs also begin to increase when the units of quantity produced becomes high. So that is one thing that we need to point out maybe at this point so that it doesn't confuse us. Now, profit is something else that we need to be familiar with. Profit, this is the favorable difference between the income earned during a specific period and the cost incurred to earn that income. That is profit. We can also, I have got a simple definition. We say profit is the reward of taking a risk Now, a loss can incur, but it only incurs when costs exceed the income. So a loss can happen in the organization. So in other words, we can say a profit occurs when costs are less than what? The income. That's a profit. So in whatever that we do, even in any business, the reason is to get a profit. Now, an income statement, we cannot talk about it. I will not discuss about it. You know all about it, its presentation, how it is done. But I'll just discuss what we see in an income statement. An income statement actually furnishes about the manner in which the profit or a loss for a particular period was arrived at. So it gives more information regarding how profit was made, what were the expenses, how much units did you sell, what expenses did you incur. So this is an income statement for you. But the objective now of financial management, which is very important, which is the crux of what we are doing, you discover that the objectives basically in terms of long term, it should be to increase the value of the business. So the long term so we can talk when talking about the objectives of number one, basically, these are the objectives of financial management. It has got what we call the long term and the short term. So looking at the long term objectives, you discover it is to increase the value of the business. So we are saying that if the business today was worth 5 million, so after 5 years or 10 years, our objectives to ensure that the value of the business in terms of assets and capital that it has accumulated could be 15 million or 20 million. But the short-term objectives of financial management is to ensure that there is profitability, liquidity, and solvency, which are the very key fundamental issues that we are going to focus on. So when we talk of profitability, you are making sure that every day all the transactions you are doing, you are carrying out, they are profitable. Number two, liquidity. You are ensuring that liquidity, when you are talking of liquidity, you are talking at the extent to which the business can convert whatever that it have into cash at any time. Solvency, again, making sure that the business is able to pay its debts at any given time. So that's basically the fundamentals that we shall also be focusing on, which is also very important, even as the manager, to be aware of such things. For we are also going to look at ratio analysis, financial ratios, so that we see the importance of making sure that the business remains profitable and the business also remain solvent. One thing that underpins financial management are its fundamentals. So financial management is underpinned by the risk return principle and also underpinned by the cost benefit principle and the time value of money. So talking about the fundamentals of now, looking at these two principles, you are talking of, when you are talking of risk, you are saying, if I'm going to invest into this project, I am going to put money, but what guarantee do I have that I'm going to make a profit? What guarantee do I have that I'm going to have my money back plus profit, plus the reward of taking a risk? So each and every project, each and every business that you might find yourself running, it's a risk, it's at a risk and is exposed to some risk, some factors, some percentage of risk. Now the question is, as managers, you need to think about the risks that you are exposed to by any decision that you're going to make, by any project that you find yourself engaging yourself into. So the fundamentals of financial management is you need to think about the risk against the return that you are going to get. So usually the higher the risk, the higher the return. But however, it will depend with what kind of a person are you, What kind of a manager are you? There are managers who are risk averse. There are also managers that are very risk. The risk averse managers who will try to minimize the risks, and also their decision making is also moderate. And also even their profits would be also moderate. But there are managers who are really risk takers. And when they risk, of course, chances are that they might fail, but chances are also that they might also make it. So you need also to look at the risk against the return which you are also going to get out of that. So here, that's why we have what you call the risk return principle. We also have what you call the cost benefit principle. Now, when you are talking of the cost benefit principle, you are saying, in this project that I'm investing in, how much am I going to get? How much is it going to cost me to invest in this project? But at the same time, when I invest 100,000, what am I going to get out of it? So that is the cost benefit principle. So as a manager, this should also underpin your decision making regarding the projects that you are about to embark on for and on behalf of the company. You need to look at the cost benefits. Another aspect is you need also to consider the time value of money. It's very important, because imagine when we were young, think about how much you used to buy bread. Think about how much bread is costing. Time value of money. Think about it. Think about how much you used to pay for public transport to go, from where you are staying to town. Think about how much it is costing now. The question might be, has the distance changed? The distance hasn't changed, but what has changed? The amount that you are paying, the taxi fare that you are paying. Think about how much you used to fill up your tank with fuel of the same car, maybe 3-4 years ago. Think about how much you are putting. So, what am I talking of? Is the time value of money. Money is also affected with times. Meaning that the 1 rand that I had 5 years ago is now not worth what it used to buy 5 years ago is not what today's 1 rand can buy. So as a manager, when you are thinking of investing, when you are thinking of embarking on projects on behalf of the company, you need also to consider the time value of money, so that when you get your profit back, still the money is still as value, and you still are making a profit. So those are the 3 fundamentals that underpins financial management. Now, one thing that is also very important is you need to look at the cost volume profit relationship as you are making out your decision. Any decision that you come up with, you need to look at that. Hence the need to look at cost volume and profit So as a manager, you need to come up, each time you're making a decision, you need to make a thorough and a very tough decision. Think about the cost of producing a certain item. Think of the cost of training, the cost of doing this business. Think of the volume that you are going to produce. Think of the quantities that you are going to buy. Think of the numbers that are involved. Say you are a wedding planner. You are an event planner. When you talk of volumes, you are talking of the number of people that are attending the event. How much will it cost you to feed those people? How much profit would I get? So there should be a relationship that exists between these 3 things. There is a relationship. Now, profitability is determined by the unit selling price of a product. So any profitability, for you to talk of profit, you need to know how many units have I sold at what price. Change in one of these three components will result in the change in the profit that we are going to earn. Let us go back to that example of selling cars when we said we had 20 cars, 20 units. 20 cars. So we have 20 cars, which we are going to call units, right? That we are selling at 100,000. That is the selling price, or the price. That is the price. Let us assume that the profit would be 75,000. Would be the profit. So we are saying that anything that happens to any of these aspects would affect the profit that we are going to make. So each of these components have to be viewed in conjunction with one another. You want to see the units that you want to sell. Oh, I forgot maybe the cost of what? The cost price, cost of production. Maybe one car is going to cost us how much? 50,000 to produce. So to produce one car, it costs 50,000. And for us, we sell it at 100,000. Okay, let me maybe revise this. This is a bit cost price 75,000. The profit is 25,000. Okay, so to produce the car, the cost of production is 75,000 per car. The profit is 25,000 and the selling price is 100,000. We have 20 cars. So what happens is, when we are talking of the cost volume profit relationship, we are saying anything that affects costs, anything that affects the selling price, and also anything that costs that affects the production of the cars would affect any other aspect. It will affect profitability. It will affect the cost of production. It will affect volume. Now, in business, again, for you to make a decision whether the business is running at a profit or not, you need to know at what point you are going to break even. This is reached where total costs are equal to total income. So when we are saying this, to produce 20 cars, one car is costing 75,000 and we have got 20 cars, right? So for us to produce 20 cars, we would need So for us to be able to produce 20 cars, you would need, one car costs 75,000 to produce. Or maybe let me reduce the numbers, so the zeros, so that it might be easier, but we can still leave it like that. But we can also talk of, it will be 20 times 7, 75,000 times 20 cars. So 10 cars would actually cost 7 million. So it would be about 1.5 million. Maybe let us simplify what? The scenario, right? Let's talk of 2 cars. For me to produce 2 cars at 75, maybe 7,500. So we would say this times 2, it becomes 15,000, okay? So what is happening is that the cost is 15,000. Right. So I'm selling the car at 100,000. I'm selling this product. I'm selling the cars. Let's say maybe it's something else. It's now I'm selling the product for 7,500. So what are we talking of now? Would say for us to get a profit, we said we are selling at 25,000. We want to see how many units, how many cars would we have bought if we sell them at that time, we sell the car even at that price. We'll look at the formula. That would be very simple. But for now, when you are talking of break even, you are looking at what point would how many units would I have sold for me to get what I've invested in the project. Let me start with the formula and then go back to the example that I was trying to give you. Now, the formula of break-even analysis . So this would be the formula of calculating the break-even analysis. So with the figures that I've given, you can now easily even simply substitute to say it costed us this much to be able to produce this. What is the break-even point? So looking at the example that I gave you previously, you can now substitute to see what is the break-even point. The figure that you get at the end N would give you the break-even point. This is the point at which when you sell this number of units, you would have not made a profit, neither would you made you would not made a profit, neither would you have made a loss. Now, one thing that we said that is very important regarding what? The fundamentals of financial management is the time value of money. Now, when you're talking of the time value of money, like I said, that the rand that is you have today was worth more, maybe is no longer worth like the rand that we were using yesterday. Now, the time value of money is also factored in financial management when you calculate the future value of some given present value. When you talk of the present value, let's say, let me borrow you 500,000 today. So the question is, if you have got 50,000 rand today, which is the present value. So the present value of 50,000 rand today, this is what 50,000 rand can buy today. And then when you are talking of the future value, you are saying, say in 5 years to come, in 5 years to come from 2014, we are saying the future end today is 2014, right? So we are now saying tomorrow, which is the future, which might be 2019, what would be the same amount, 50,000? That is the future value. So you're asking yourself, what would 50,000 rand be worth in 2019? It's obvious because of other factors like inflation and the like that 50,000 in 2019 would be worth differently. It will be worth less, or because of time. Time would actually depreciate this value. Time would actually, because of the increase in prices and other things, would also affect the value and what it could buy. So in 2019, 50,000 would not be worth what it could buy today, that is in 2014. So that is basically what we'll be looking at when you look at the time value of money. But there is also a relationship that exists between the present value and the future value. Now, when you are talking of that present value, the relationship that exists, and from the example that we're talking, from what illustration I gave, is the compounding interest. That is the passage of time. Passage of time also does something to money. And what you need to do is you need to discount for that. Now, the future value of a single amount is used to calculate the future value of today's money so that we make sound financial decision. We do that by calculating what we call the future value of a single amount, and this is the formula. F right? So this would be the formula of calculating the future value of a present amount, of a single amount. What you do is you compound. The interest rate is always given. So you discover that what then happens is, and if you are shown any question, shown any examination question, what you need to do is from your textbook, if you are to see in the exam, in the textbook, what you need to do is you need to know the formula, and then what you know is in this formula, what does PV stand for? And we are saying PV stands for the original investment value, that the investment or present value of the amount that you are talking of. So even in the question, the amount would be clear. You need to read clearly on the statement and actually see it. FV would actually stand for the future value of that amount that has been investment. I would stand for interest. So the interest, again, in the question or in any scenario would be given. The N is the number or if years or the period in which the amount has been invested, is going to be invested or is going to be invested. So it's actually very simple, and once you do that, you just apply this, because what you are doing is you want to calculate the future value. And when you calculate the future value, you need to know the present value. In brackets, the number 1 is a constant amount. So 1, you add it to the interest, which might be 0.05, you add it to 1, in brackets, to the power n. And when you say to the power n, you actually use that. If you put, using your sharp calculator, you can put everything in brackets and then to the power n, which is to the power, the number of years that you are investing in. Now, you can also be asked to actually calculate and see the present value of a single amount. Now, the formula of the present value of a single amount would be PV Okay, so the formula would be like that. And again, if you are looking at using the PV would be the present what? Present value. Present value. So this is what is also important even when you are trying to use and apply the present value of a single amount. You need to know that PV will stand for the present value of investment, FV, that is the future value of investment, and N to the power N as the number of years or the period that the investment is going to be made, and finally with I is just the interest. So when you play around with the figures in a substitute, you are able to quickly get what? The present value of a single amount. Now, when you look at the next thing that is also very important that we need to, what is also very important again, is to look at financial analysis or ratio analysis. Now, financial analysis, like we said that financial management, also one of the underpinning of the objectives of financial management is to ensure that there is this administration and to ensure that there is liquidity in the company and profitability. Now, as managers, these are very important as in that when you draw up your income statement, right? We draw up your income statement, you draw out your balance sheet. What is important is, as managers, we use those figures for analyzing the performance of the organization. So when you are looking at financial ratios, we make use of the income statement and the balance sheet for us to be able to understand and to know where the situation that the company is in. We have what we call, number one, the liquidity ratio. So we have what we call liquidity ratios. So these ratios, they measure the rate at which the organization can meet its short-term obligations without curtailing or ceasing normal activities. We are saying, fine, as an organization, you might find yourself in debt, but at the same time, you need to be able to manage your debts. And managing your debts, you need to also to see at what rate are you able to actually pay your debts without affecting any other activities. So when you want to check that, you carry out what you call liquidity ratio. You can either use what we call current ratio, whereby you look at the total assets and then divide them by total liabilities. The figures that you get, you go to the total assets in the income statement, you see the figure for total assets, that is the one that you put at the top. You divide that figure by the total figure in your income, in your financial position statement, in your balance sheet, whereby there is total liabilities. So you add both long-term and short-term liabilities. The acid test ratio, again, is another method that also you can use to check your liquidity. Here you still take the current asset rate, the total assets, but you subtract inventory, you subtract stock, and when you subtract stock, then you have got current what? And then you divide that amount by current liabilities. So with this one, you can actually see how liquid your business is. We also have another ratio which is called the solvency ratio. Now, when you look at solvency ratio, we have got two types of two ways in which you can actually see how solvent you're actually indicating the ability of a business to repay its debts from the sale of assets on cessation of its activities. Let us assume that things happen even in business, and you've got assets and you've got credits. So you are saying that, okay, of the assets that I have and the credits that I have, will I be able to pay my debts if anything happens? So when you want to calculate this, you use what we call you use solvency ratios. And solvency ratio has got what we call debt ratio. So when you are looking at and calculating what we call solvency ratios, what you do is you use two methods. It's either you use what we call the debt ratio. You look at your total debts that you have, and when you find them, you divide that by your total assets. And when you are not talking of your assets, you are looking at the total assets, both fixed assets and current assets. That figure, you multiply it by 100. And when you are multiplied by 100, the figure that you have will tell you at how many times do our assets pay our debts. Gearing ratio can also be used. This is whereby you take owner's equity, how much the owner has contributed, divide it by total debts, and you come up with a figure. Now, we also have what we call profitability. So many ratios are involved here. We have what we call the gross profit margin. I'll send you PowerPoint notes that are showing us how do you calculate that, and make sure that you exercise and go through them with an income statement and a balance sheet. Take those figures and you work out the examples. You will discover that it is a very simple thing to do. Now we have got what we call gross profit margin. Here you take gross profit divided it by sales times 100. You also have return on shareholders' interest. This is calculated as net profit after tax divided by shareholders' interest times 100. Net profit margins is also net income divided by sales times 100. So all those figures, you will find them in the income statement. Return on owner's equity calculated as net income divided by owner's equity. Return on capital, operating capital, the operating profit less tax after taxation divided by total assets times 100. All these figures would show you the rate at which the company is actually earning its profit. Now, we also have what we call financial planning and control. It is very important to, as a manager, to be able to sit down and plan and also come up with a control based on that. Now, this is done in businesses that are large or small. So businesses, whether you like it or not, sometimes they sit down and draw up what we call a budget. And a budget, a company that does not operate on a budget, they are always actually shooting over the roof, overspending or underspending. So we have two types of budgets, which we call operational budgets and financial budget. Operating budgets, these ones, they include cost budget, income budget, and also profit plan and profit budget, whereby you're sitting down and say, okay, if we make this profit, this is how we are going to use it, and also this is the income we are likely going to make, and also the financial budget that includes the balance sheet budget, financial budget, the cash budget, and also the capital expenditure budget. Now, looking at some of the types of budgets, we have what we call the traditional budgeting. Now, with the traditional budgeting, we look at issues like this use the actual income and expenditure of the previous year. And on that basis, they make decisions on what they are likely going to use for next year. There's zero-based budgeting. This enables the business to look at its activities, priorities are fresh on an annual basis because of historical results are not taken as a basis for the next budgeting period. So what they do is they just do everything, like say, from scratch. So they might also be doing everything from scratch, and this is the zero budgeting. Now, sometimes companies make use of zero budgeting because of changes that happen in the environmental system. The environment changes, so hence you might need to start afresh again. Now, a balanced scorecard again is also used as you are actually doing your financial planning. We have done that, I think, in some section, but it enables managers to align their department's budget into that of the mains and firm's vision and mission. Now, the approach actually suggests about 4 things. Number 1, that the strategy should be implemented from the financial perspective, customer's perspective, internal processes, learning, and growth. So hence, you can actually make use and draw of that, the balance scorecard, and come up with your budget that is also user-friendly and that is usable. Now, management of cash and marketing securities. Now, in any company, there is a cost of holding cash. Why? Because when you hold cash, besides thieves, we are also saying that when you hold cash and it is nothing that it is doing, it loses its value. And when it loses its value, what happens? what it could, remember we talked about the time value of money, that if you have 50,000 today and you don't do anything to it, you don't buy anything, tomorrow it will be worth less. So as financial managers and managers, decisions, tough decisions need to be made regarding on, if we have this money that we don't want to use now, what else can we do with the money? What else can we invest it? Can we earn an interest with that money? So you have to be very careful with issues of loss of purchasing power of that money. So there is also a cost of little or no cash at all. The loss of goodwill, the loss of opportunities if you don't have money at hand. An opportunity might arise, but because you don't have money, it goes. Imagine how many times we have thought of doing something, and because our cash is held somewhere, we find ourselves not being able to make a straight decision. You might also be able to claim discounts if you don't have money within our coffers. So as an organization, you need to keep a balance as to how much is too much money and how much is little money for us, so that you are not found on the other side of the track. Again, if you don't have money and you need to do something, there is what we call the cost of borrowing. Imagine that the company had 10 million, and that 10 million that it didn't want to use, it decides to invest it at the stock exchange. But the money you would be investing would actually mature in a month's time. And within that month, you need to pay salaries. The money is maturing maybe on the 30th, and your salary due date is the 25th. What are you going to do? Explain to your employees that you cannot pay them. That won't be acceptable. So what would you do? You might choose to borrow. So borrowing is costly if you don't keep an actual amount, as to say, you don't actually manage your funds, as to say, how much money can we keep and how much money can we invest? Now, when you are in the process of investing again, there are so many decisions that are very important that you need to make. Number one is when you are investing money, or maybe retaining a certain amount of cash available. You might have it for transaction purposes. That is for making day-to-day transaction, paying telephone bills, paying allowances, and etc. But you can also have it for precautionary purposes, meaning that if anything of emergence arises, you might need also to use it. You might also use it for speculative reasons, meaning that if there is any change in the industry and you might need to invest into a certain project, you do it there and there, paying cash without any excuses. Now, in any company, again, we cannot stop end this subject, this chapter, without also talking about the cash cycle or the cash budget. Now, you will discover that in any company, once you invest and you invest into a project, you start with cash. With that cash, you buy, let me just draw the cash cycle. This is what we call the cash cycle. So ideally, in a typical organization, you start here with cash. And then what do? You go buy raw materials. When you have the raw materials, you produce them, you come up with finished goods. When you have finished goods, you also sell them. And selling them sometimes, because money is difficult to come by, you might sell it on credit. And then there is also a stage of, then you get your cash back. So you have to fall, that cash goes into 3, 4, 5 stages before you can have cash back. So It is also important, even as a manager, to understand how cash flows within a company and also make appropriate decisions, especially on this aspect of managing debtors. You need to have the capacity and capability as an organization to be able to manage your debtors. Now, debtors arise in business when we sell goods on credit. Credit guaranteed individuals is referred to as consumer credit. Now, there are three more important aspects of credits in an organization. Come up with what you call a credit policy. Under what circumstances do we give people loans? Credit terms. For how long would we want the people, maybe any person who would have borrowed to continue selling, or maybe to how many months would it take for them to pay back? Those are credit terms. And you should come up with a collection policy to say on which day will we be able to collect all the money. Now, in a collection policy, this one is very important. I remember last year it was also examined. Now, when you talk of credit policy, it has got 4 C's that are very important when drawing up a credit policy. Number one, you need to look at character. That is why even when we are borrowing money, people ask about who we are. They want to check our credit record. So why they are doing that is they are looking at your ability to pay debts. Capacity, they want to look at your pay slip. They say, okay, when you look at capacity, we say, do you have a pay slip? What form of income are you using? Do you have for you to be able to what? So, when drawing up a credit policy, would look at number one, character. We have capacity, conditions, and we also look at capital. Now, for companies, for them to check our character, they want to see, they look at your credit history. When they are looking at your capacity, they can make use of your payslip. When they are looking at conditions, these are terms in which they would actually allow you how you would be able to pay. And when you are looking at capital, again, you can refer that to your payslip. Now, this is very important when you are drawing up a credit policy. Look at those things. See if it is if this person is actually what worthy to actually worthy to offer something on credit. So when you are talking of terms here, you might talk of discounts, interests, etc. Now, stock again is something that is very important, and you need that ability to be able to manage stock, right? There is a cost of also holding stock because it is depreciating in value because of dust and also some insects that might devour your things. And it might also be in the form of storage cost, insurance cost, or also loss of interest. Now, the cost of building little or no inventories cost might be the loss of customer goodwill. Imagine if you don't stock enough and then somebody calls and say, we want 100 of this. Then you say, we can't offer because you don't have those things in your stock. So that customer might not even come tomorrow. There might also be loss of flexibility or reorder cost. So that it is also very important when you are actually looking at such issues. Now, another issue that is also very important when looking at cash flow concept is then calculating and looking at the net present value. Now, this is a method that is used to calculate a net present value. it actually, when you are actually using calculating the net present value, you are focusing on 3 components of a project: deciding on the appropriate discounting rate and calculating the present values of maybe of any projects. Let us assume that you have been tasked by and approached by a company, and you need to see whether this is a project that is worth pursuing or not. Because there are some projects, based on the amount of money that you are given, you will discover that you will not be able to make money out of it. Hence, basically, the formula for calculating net present value would be, would abbreviate it as NPV, is equals to that would actually calculate and give you a figure for the net present value. This can actually be used, say, if you are calculating, comparing various projects, and you can actually make a decision based on that. So one thing that is important, the criteria for making a decision, is that accept all independent projects with a positive value, with a positive. Reject all projects that has got a negative. Project with a 0 make no contribution to value and are usually rejected. So projects that has got a positive figure at the end, when you calculate the present value and minus, and the figure is present, you say it is a plus. But a project that has got a minus, you cannot invest in it. So what are we saying? We're saying that if you calculate, looking, say, in your textbook, the exercises that are there, you discover that if a project gives you a positive figure, this is a figure without any minus, right? And if it is a positive, you say, take it. But if it is negative, we say, no, drop it. If it is a project that has got a 0, we also say what? Drop it, because you are not going to get anything. You are like doing charity. Okay? Now, we have talked about risk, and say there's, in business, there are so many situations that makes us, that are so much, that brings uncertainty within us. Now, we have got money markets and capital markets. A money market is the market for financial instruments with a short-term maturity, where you can invest your money. Remember, you can also borrow and lend for periods of 1 day or a few months. Funds required for long-term investments are raised and traded by investors at the Johannesburg Stock or the capital markets like JSE. Now, we have got type of institutions in South Africa that can offer such services. You can deposit, we have institutions that we know that can take your deposits. Is South African Reserve Bank. These are the bankers of banks. The Land and Agricultural Bank, the Corporation for Public Deposits, private sector banks like FNB, Standard Bank, Nedbank. We also have the post office. Now, type of institutions that also handle and that also deal with finances would be in the public sector. We have the public investment commissioners, private sector, life insurers, pension funds, provident funds, short-term insurers, and the like. Other institutions would be like Industrial Development Corporation, the Kula Enterprise, and Sika Enterprise, Development Bank of South Africa. Now, all those are institutions that can also assist you and your company if you're actually making decisions to borrow or to invest. Now, let us say that in your company you find yourself without what? Without money to use, and you are waiting for somebody who's going to pay maybe in days to come. Here we talk of short-term financing. Now, we can get a bank overdraft. This is a facility that the bank allows you to overdraw your account, and then interest is also incurred, and this can only happen on a check account, and it bridges the gap between maybe when you don't have money and you need to do some transaction, right? We have different types of equity. That is also very important to talk about. And this could be shareholders' interest. This is in a company is subdivided into owners' equity and preference shareholders' equity. This is what we call shareholders' interest. Owners' equity, number one, consists of funds that are made directly available by the legal owners in the form of share capital. This is what we call owners' equity. There is money that the owners directly invest into the business. The money that the owners start to use when operating the business, that is what we call shareholders' interest. Under owners' equity. But we also have what we call preference shareholder capital. This is between debentures and ordinary shares in terms of risks. And these are people who can also invest further into the business. Now, for owners' equity, again, we have got two types of shares. We have what we call par value shares and non-par value shares. Now, when you look at the owner's equity again, liability of ordinary shareholders is limited to the amount of share capital they contributed to the business. And in this type of scenario, there is no certainty that money paid for shares would be recouped. Ordinary shares in a listed company are tradable on the stock exchange, so it means you can still also buy or sell shares in that. But with preference shareholders, you discover that they have a preferential claim over ordinary shares, that is the preference shareholders. They have a preferential claim over ordinary shares on assets of the business in the case of liquidation. The term of availability is limited. But we also have what we call long-term debt. This refers to debt that can mature in a year or more, even up to 20 years. Usually, this one is obtained in two ways. It can be through loans or through financial leasing. Now, let's say to close off this chapter on financial management, if you're a small holder or a small business owner, there are ways in which you can also borrow and get money. You can take it from personal funds. You can get loan from businesses. You can also trade credit. You can also have mortgage loans. Commercial banks can also give you loans, small business loans from Kula enterprises. You can also take part in taking partners into your business. That way you can also get a loan. So in closing, we can see that we've touched a lot of things just to give us an appreciation of what financial management is all about. However, this information is just for us managers to know more about how we can make decisions as financial managers. But in any organization, you discover that you would have a support structure from financial managers as experts that can actually help you in making decisions. But this chapter is included for us as managers to show us the key areas that need us as managers to be able to make decisions. Thank you. Thank you very much. I'm glad to meet you once again into the second last segment, whereby we are looking at Learning Unit 5 and Learning Unit 5, which talks about purchasing and supply management. Now, purchasing and supply management is one of the in thing which so many companies have been actually ignoring at for a long time, as it has been looked down upon as just a function that is one of those functions within management. But you discover that because of time and the essence and the value of quality has continued to be preached about, and managers beginning to appreciate the importance of managing quality right from the beginning. This has actually brought the importance of learning and wanting to understanding more and attaching value on purchasing and supply management. Now, with quality, for you to be able to, you cannot also manage quality of a product considering on the way in which you are doing your things from the plant as you are manufacturing. But research has proven that you need to manage quality from the beginning. If I'm going to use if I'm going to use like flour to bake bread, for me to have a quality product at the end of the day, not only lies in the way in which and the environment in which I bake my bread and make my bread, but it has to go back to the way in which it was plowed, how it was planted, how it was grown, how it was nurtured, what chemicals were used in the process of making it grow. So that means that you are actually looking at the grassroots of the crux of purchasing and supply. Now, purchasing and supply, once again, is another task of management, and there are so many processes and activities that are involved. You discover that as a purchasing and supply manager, or somebody who is in charge of purchasing and supply, you need to be somebody who is abreast of better substitute of the current products that you are using. You are like a buyer. You are the buyer of your institution. Sometimes you might find yourself buying a variety of goods or materials. There is a level of expertise that is required for you to be able to buy the right material. You need also to have the eye for quality and ensure that the goods are of quality. Other than being goods of quality, you need to ensure that they are supplied at the right time, when exactly you need them. Now, the function also involves issues like selecting your suppliers. Who is going to be your supplier for certain products? So you need to undergo various activities whereby you are identifying your suppliers. You also need to arrange for transport. Having bought the goods, how is it going to be transported? What mode of transport are you going to use? Is it going to ensure that our products reach us fresh? But even if we have manufactured, again, we need to supply them to what? To our clients. How are we going to ensure that the goods that we have manufactured still reach our clients, still being fresh and still being intact, not having been disturbed by a lot of factors? Let us think about what happens in the dairy farms. There's milking of a cow, the physical job of milking milk from a cow. But the next stage is, how would you ensure that a client in Soweto, a client in Eastern Cape, receives and gets that milk at the doorstep of their homes and being fresh? We all know that milk is easily perishable. So you also need to look at, and as you are arranging transport, you also need to look at such issues. You also need to determine the price. You also need to look at the price of the product that you are buying, and also need to look at profitability. You also need to consider issues of warehousing. Since I've bought these products, where am I going to be putting them before they are being used? Remember, we can also stock some raw materials before they are used, so you need also to consider that. You also need to look at the time for purchasing, the time frame. If we are going to stock the goods in the houses for a long time, there's no doubt that deterioration is going to affect the quality of the products. Hence, all these aspects needs to be considered by somebody who is called a buyer or a purchasing manager. Now, one of the greatest expenditures of any business is the cost. The biggest expenditure is on cost of saving, on buying. One thing that is very also important as you are actually buying your goods is to make sure to understand that stock levels that are very high might also disrupt, might also make the company not to run profitably. Or if you don't have so much enough, it might also disrupt your day-to-day activities because you don't have enough material. There is also another issue of the purchasing material. The purchasing material has to be of the right quality, the right quantity and size. Otherwise, you might buy products that might not be of any use to your manufacturing guys. So you need to come sit down and do what we call purchasing and supply planning. Now, when you are sitting down to plan for purchasing and supply, this should be conducted in consultation with other areas in the department, other departmental, other functional areas of the business, like HR, marketing, what materials would they need for promotion, and the like. Hence, purchasing planning involves everyone. So we can say purchasing and supply involves everyone. And what do we mean by everyone? We are saying these are all the levels of management, right? We are saying this is the strategic level. This is the tactical level. And this is the operations level. And we are saying purchasing and supply involves everyone. We are saying it involves everyone. That is planning. So you also need to organize planning. You also need to organize purchasing, because if it is not organized, a lot of confusion and chaos would easily erupt and cause disruptions, hence affects profitability of the company. There are four main issues that need to be addressed as you are planning for purchasing. Number one, the place of the purchasing function in the organizational structure. Where do you put it in the structure? So when you're organizing planning, this is the organization of planning, of purchasing, sorry. You need to look at structure, purchasing put it into the organizational structure. Number two, the other issue is So these are the 4 aspects that are very important when you're organizing purchasing. Number 1, put it into a structure, into an organization. Number 2, make sure that the internal structures in your organization are aligned and you organize it for purchasing. Coordinate all the activities and functions of the organization so that they are also aligned with what purchasing department is planning, and also consider the cross-functional activities. Now, as you are trying to organize purchasing, you might also think of things like, should we centralize or decentralize purchasing? When you're talking of centralizing, you are saying that purchasing is done by one institution. I mean, by one big office, and it buys for various sections within the organization. Or you can say that each and every section, each and every department within an organization, they handle their purchasing function. So that is a decision that managers can always make on their own. Now, when you're actually internalizing or the organization of the purchasing and supply function, you need to come up with specific activities that needs to be done daily or annually, weekly, or in groups in terms of negotiation of purchasing, follow up and expediting of the purchasing process. Sometimes you might order something from someone in Dubai, but you need to make sure that things are done. You have ordered something from China. Who's going to keep track to say where are the goods? There is need for administration of the purchasing function, and there's also need to have an arm for purchasing research that department constantly be looking around to see the best methods, the best places where you can buy your stuff, and also do what you call inventory holding, whereby you are keeping your stuff before you've distributed them to respective departments. Coordination is also very important, and it has got 3 levels. So when you are talking of coordinating purchasing, so one thing that when you are talking of coordinating, we are saying all the activities within the purchasing functions need to be interrelated and make sure that there is a flow of activities so that it does not disrupt any activities, maybe disrupt any process of, say, manufacturing, any process of meeting the demands and the needs and wants of the customer. Now, cross-functional sourcing teams are very important when you are actually coordinating the purchasing function. Number 1, it is important to select supplier. Have a team that focuses on selecting the best supplier. Negotiate corporate-wide purchasing agreement to say, as an organization, when we are purchasing something, these are our terms. Can we agree on these terms so that everything is loud and clear, so that it also does not affect your cash flow from financial management that we're doing? Another aspect is you need to develop sourcing strategies to say, how can we purchase these things in bulk? Can we join with others so that we buy those goods in maybe at a cheaper price or maybe at a discount? Developing suppliers and the evaluation of supplier performance. What you do is, when you develop suppliers, you deliver. They also deliver goods that they've promised. But after everything has been said and done, it is very important to sit down also and take an audit and list your experiences with one supplier. Remember, a relationship has to be built. It has to be a relationship that is not one-sided. It's a relationship that is two-sided. For instance, if we are going to buy raw materials from company A, and if that company A delivers on time, the right quantity, at the right price, We are also expecting and we are obliged to pay them what is due to them fully. So when we are carrying out an evaluation of suppliers, what we are now doing is we are taking an audit and comparing, seeing who is the best performer, who is a supplier whom we can stick to and decide to build relationships. There are some suppliers who are not worth pursuing because they might disrupt our business and also affect even our profitability. Now, there are activities that are involved when you are assessing the purchasing and supply management. You need to come up with control points. Control points to gauge effectiveness of that purchasing and supply activity. Number one, you look at the price proficiency. Are the goods, the raw materials that you are buying, are they at the right price? Because there are sometimes you might find yourself buying goods that are 10 times the original price. So you need to check on that. Check on supplier performance. I've commented on that. Timeliness. Did the supplier manage to supply what we asked for on time? But the method of purchasing that we have used, the transport that we have used, has it made us to save costs? Yes or no? Workload. What was the workload that was given to allocated to all the members of staff that were involved? What were the cost of purchasing were involved in terms of telephone bills, the cost per hour, say the time that each employee was going to spend in making a follow-up? Inventory holding. What are the costs of holding that inventory before it has been used? Relationship performance with suppliers. Are they good people to work with? Relationship with other functional areas. Are other functional areas happy with the times and the type of goods that we have ordered for them? So all those are activities that you need to check and take an audit and come up with a way forward. Now, let us look at the purchasing process. Now, with the purchasing process, you will discover that there are steps of the purchasing cycle, which might include, number one, development and description of a need, to say, we need to buy this. We have a need of this type of a raw material. Who are our suppliers? Choice of suppliers. Choose in a pool of many suppliers who are saying we are doing this. If you find these days that on the internet, there is the danger of falling into the traps of people that can actually rip you and make your company not to be profitable. Everyone is selling something, but the question is, have you dealt with the supplier? Is it the best deal? Reach on prices and availability. Research on those such things. Issue the orders and concluding a contract. How long does it take? Sometimes it might take long. Another aspect is follow up and expediting the process. Carrying out a receipt, inspection, and distribution. Sometimes, depending with the type of raw materials you are ordered, you can go for inspection. Test the equipment before you can buy. Sometimes it might involve somebody going abroad to test the equipment and come up with a decision. Handling errors and discrepancies. Sometimes we are not always perfect. There are errors that can also occur. Paying for the order, then closing the order. When you close the order, you close it when the goods have been delivered and you have fully paid everything. Now, like I said earlier, quality is a decision that has to be made as you are purchasing and supplying your goods. Number one, you need to determine the right quality that you are requiring. So it means a team of engineers, designers need to be considered, need to have a say in whatever that you are doing. You need also to describe what is quality. And quality simply means fit for the purpose that it has been designed for. There are specification standardization. You also look at brands. You also look at standard like SAB standards. You also look at engineering drawings and samples to see if it is of the right quality. You also need to control quality lest things can be done otherwise. Now, having looked at that, you discover that deciding on what to buy will not be a problem. Another issue that is also very important is the selection and management of suppliers. You have found that maybe there are about 100 suppliers all claiming to produce and deliver to you a quality product. But how do you select? You compare a list of suppliers, reduce a list to a short list, looking at other criteria, whether are they near to you. Remember, you need to consider transport costs. Shortlist suppliers requested to give a quote and request those people to give a quote and start to negotiate and see which one would give the best deal. Developing suppliers. In South Africa, we have got the BE policy. So you really need to look at the BE policy, what it says in terms of suppliers and sourcing them. Build long-term relationship with your suppliers so that all of you understand the main reason that you are into. How do you come out with the pricing decision? Determining the price. There are various methods that we can use, and it depends on the nature of materials and the value of the transaction. Otherwise, there might be published price list. You can do quotations and you can seek tenders so that you can actually come out and compare which one is offering the best price. Now, there's one thing that is also very important in as much as we might order things. Timeliness. Are the goods that we are going to order going to arrive at the time that we really need them? Are they going to come too late, or are they going to come too early when we don't have place for them to stock them? So time is very important when it comes to such issues. And timeliness is also affected by so many things. Number one, issues like internal factors. If within the departments there's no proper communication regarding what to deliver and what not to, what to order. If people are going to say, as they are in the middle of manufacturing, they say, we no longer have this part of the raw material, and then they'll be expecting the department to release it on time, and then it won't work. External factors might mean like issues like strikes, issues that are beyond the organization's control. So all those things need to be considered when you are doing the function of purchasing and supply. Thank you very much. This is what we need to know for now regarding Learning Unit 5. Thank you. Now, thank you very much. Welcome to the last and final segment of this module, Business Management 1B. We are now looking at Learning Unit 6, which is the last one. And you will find out that for Learning Unit 6, the chapter is not in our textbook if you are using the 9th edition. The material for this chapter, you will only find it in the manual. However, I'll also email you some PowerPoint slides that also look at this, what we are going to discuss today. Now, any company, any organization, we have said that they sit down, they find time to plan. Planning plays a very important part in any business. And for a business to run and operate effectively, and for it to continue to make profit, there comes a time whereby they need to sit down and plan for their future, plan for the activities that they are going to have. Hence, the introduction and the coming in of strategic management. Now, strategic management basically looks at three and tries to answer three issues, three questions. The questions that strategic management tries to answer are, number one, where are we now? Where do we want to be? So, one thing that is so interesting is that as an organization, as managers, you need to sit down and take an audit of where are we now? Where are we now? We are trying to answer questions regarding performance, company performance, the number of branches that you have opened, how many employees do you have? This is where you are today. And then you continue again to say, but is where we are where we want to be? And then that's where you come up with a question, where do we want to be? Are we at the right place, or are we at the right, is it where we are, or is it where we want to be? So you come up with a question, where do we want to be? And then people sit down, they brainstorm, and then you discover that no, you want to be an international brand. You want to be recognized throughout the world. You want to be recognized throughout Africa. You want to be recognized throughout South Africa. So maybe you want to be recognized throughout South Africa. That's where you want to be. So you come up with an answer and say, this is where we want us to be. But knowing where you want to be is not enough unless you come up with a plan to say, how am I going to go there? How am I going to reach that destination? So, in all essence, what are we trying to say is that strategic management involves the process of identifying where the organization is, where it wants to be, and how it is going to reach. So it's a way of crafting strategy, coming up with a game plan. So whatever, how they are going to, the how part is going to be answered by strategy formulation. Strategy formulation and strategy implementation. Or you are going to come up with a game plan. Now, whatever plan that you might have as an organization, big as it is, making an impact as it is, ensure that the plan or the game plan, the strategy that you have come up with aligns well with the organization, its environment, and its functional areas. Because if you fail to do that, we can say you don't have the capacity. You have demonstrated that you do not have the capacity to expand and grow as the way in which you have wanted. Now, external alignment of the organization, basically, this must be a good fit with the purpose and threats found in the external business. So you are now looking around you and saying, in my business, what is going on around me? How is it going to affect my business? The same applies with the internal alignment. Whatever that is happening in the internal environment should also be aligned with what you want to achieve. Now, let us look at what constitutes the internal environment of any organization. Let's just go back quickly to the basics. The internal environment would constitute things like strengths, Now, as we're talking about the alignment of both the internal and the external environment, these are some of the things that you need to look at. Opportunities for the external environment, threats, the market environment, the micro environment. How is it not affecting? How is it impacting positively or negatively to the internal environment of the organization so that you reach where you want to be? The internal environment, again, you weigh your strengths, you weigh your weaknesses, you weigh the vision, look at the mission, your objectives as a company, and also even your culture. And then when you look at all those things, see if it's going to affect what is happening in the external environment, and see how it is affecting you and making you to be able to reach where you want to be. Now, another thing that is also very important is the strategic management process. Now, what happens is that you need to start with a direction, like where we say, where do we want to go? Come up with a direction that is inspirational, something that motivates you as a company, that gives you courage even as a team, and everyone wants to reach there. It has to be short enough to remember. So that's the vision of the organization. Now that you have direction, it needs to be closely aligned to the organization and not to be a generic statement. When you are talking of a generic statement, it's a statement that is general. That might mean so many things. Now, having looked at that, we have got here a mission statement that is more concrete, and describes how the business is going to achieve. Now, a good statement, mission statement, basically should have about 3 things. What is our business? Which customers? How do we provide our product or service? What is our business? Who are our customers? And how we are going to provide for that the product or service. Now, we have an example that I'll read out here that is in our manual of the vision and mission statement of UNISA. This is UNISA Graduate School of Business Leadership. The vision is to be the leading African business school of choice, offering internationally recognized leadership and management education. The mission reads, preparing today's leaders for tomorrow's challenges through the provision of affordable quality education and knowledge, training and developing dynamic, ethical leaders for Africa and globally who value diversity and are dedicated to enhance human prosperity on the African continent and globally. Effectively utilizing open distance learning to deliver quality business education in Africa, to continuously engage in cutting-edge research to produce new knowledge in the field of management and leadership. That is there. That is the vision and mission of UNISA. Now, looking at the vision and mission of UNISA, one thing that is very important is that you can actually pick, I want you to sit down, pick areas, statements that are highlighting on the product, statements that are highlighting on the who their customers are, and statements that are also offered explaining how they're going to provide their service or product. I will start. Number 1, you discover that on the mission statement, there is a training and developing diversity. This is also partly explains how they are going to provide it. It's that it explains their product or service. This explains their service. They are into training. How do we provide our product is being offered here, is being explained here, where it is written, effectively utilizing open distance learning. Effectively utilizing open distance learning. That is also showing how they are going to provide their service. How about what is our business, our product or service? This is also mentioned in training and development, and also, that one I've mentioned it. Which customers or markets do we serve? They are talking of Africa and the globe. And this is here's the statement that is talking of Africa. Effectively using open distance learning to deliver quality education in Africa. Another statement again says, training and developing dynamic, ethical leaders for Africa and globally. So the statement for Africa and globally shows us the business that they are into. It shows them the market in which they are operating. Now, going back to the process, now that you have set up the strategic directions, objectives, you need to come up with strategies. How are we going to go there? With a very good mission and vision statement, you need to come up with a plan. With UNISA, they've come up with distance learning, whereby each and every student is given an assignment and is supposed to submit on a specific date, and they are going to sit exams. And then you implement. Controlling, you need to check whether students are submitting assignments on time, whether they are being marked on time, and etc. But at the same time, you also need to look at the environmental analysis. How is it affecting both the internal and the external? regarding the issue of identifying whether the mission statement is a good one or a bad one, I want you also to do that, the First Bank mission statement and the SAB Miller, and see whether it is actually covering and also capturing those three components that we have come up with. Now, in setting the strategic objectives, objectives need to be SMART, meaning that they have to be specific, they have to be clear, measurable, attainable, realistic, and time-bound. When you're talking of objectives being specific, you need to come up with clear objectives that everybody would know what exactly you want to achieve. Measurable, you need to have something like figures that you incorporate to say, by the end of 2015, I want to have bought a Ford Ranger. That is an objective. 2015, the end of 2015. And 2015 ends where? In December. I want to have bought what? A Ford Ranger. So 2015, we can re-look and see a Ford Ranger there. Objectives also need to be attainable. They have to be possible to attain. Realistic, this is quite clear, and also time bound. There should be a time frame, like I said, 2015. Now, another thing that is also very important in the strategic planning process is the implementation. Now, to plan is one thing, but to implement is also another thing. So leadership is very important and is an important component of strategic implementation. Leaders have to communicate the strategy and gain buy-in from employees in whatever that they are doing. Because employees, if you underestimate them, upon implementation, things might be difficult. So it is important to ensure that whatever that happens, you incorporate what? Employees, and things will actually work out as accordingly. Now, to be an effective leader, leaders should possess most of the capabilities of each and every level that we have. Level 1, you have to be somebody who is able to make productive contributions through skills, talent, and knowledge. As a leader, you need also to contribute towards the success of groups and work it effectively in a team. As a leader, you need to organize people in a way that achieves objectives in a productive way. As a leader, also, you need to obtain commitment to a clear, compelling vision and stipulate a group to perform at a high standard, and also build enduring success through professional will and personal humility. That's all about some of the qualities that a leader would actually is expected to exude and for them to be able to succeed. Now, corporate culture also needs to support the strategy that you are coming up with. The culture of an organization can be looked at through cultural web. Now, the cultural web, there are so many things and ways that are done in a business. These behaviors that members of the organization display to people both inside and outside. For example, a routine could be having a short staff meeting every morning. That's a culture. Rituals, these are activities or events through which an organization reinforces what it believes in, its values and norms. For instance, each department has an informal social gathering once a month. Once a month, people meet, they chat, and they catch up. Stories about events and individuals highlight what is important to the organization. This refers to things that have happened in the past, such as someone going beyond their duty to satisfy a customer. That is where in other companies, for example, you hear them writing about success stories to say, this is our hero. This is our monthly hero. Now, think about these things. Does senior management interact with lower management? Are management accessible to workers? Are workers' voices heard in the company in which you are working for? Think about the answers. Now, there are so many ways that we can also demonstrate culture: symbols, logos. Each and every company has got a logo. This one is this also tells us of the organizational culture. The layout of offices, power structures, control systems also refer to measurement and reward systems which shape behavior in an organization. For example, if control system rewards speed of work, quality may suffer. We also have issues like the organizational paradigm that links each and every element together and actually has an overall picture of how employees sees the organization. So after everything has been said and done, each and every employee has got a picture and they say, oh, this is what I think about the organization. Now, control is very important. And if you are to look at what we have done, strategic control, you will discover that if you are to refer to your chapter 10 in the same textbook that you are using, something is also talked about regarding control. Now, there are examples of the types of information that include customer transaction. Managers need to be able to easily monitor the performance of the organization as a whole. So that's where control starts and also ends. Another thing regarding strategic management is that strategic management is a long-term planning. And long-term planning, a lot of consultants and experts recommend that long-term planning should not exceed 10 years. Why? Because there are a lot of things that changes in the environment that might affect the way the business is running. Ladies and gentlemen, this brings us to the end of this chapter and to the end of this learning unit and to the end of the content that you're supposed to cover for Business Management 1B. I hope these sessions have been helpful to you. My advice is that, like what we did last semester, make sure that you have notes that you have created as you are preparing for your final examination. Work on the revision exercises and questions that are at the end of each and every unit, for each and every learning unit in your manuals. Interact with other students. If you have got questions and queries, you are most welcome. Please contact us. Do not hesitate to contact us. We are there waiting for your comments, your contributions, and also there to help you. Thank you very much.